my name is Dana Golden. Today we're going to finish up our fundamentals derivatives portion of the commodity markets derivatives portion of our class with a look at models of price discovery in commodity markets. So in particular, we're going to look at Kenneth Medlock's model, which focuses on how price in commodity markets are determined through the interaction of supply, demand, and market structure. So the key components, you have supply, production cost, research, availability, and technology. You have demand, you have some physical factors affecting what people are using in end-use applications. People need solar panels, so they need silicon, copper, and silver. In the market structure, you have this integration between the physical and financial markets where they can affect each other, and you have the role of storage and arbitrage opportunities creating these frictions in the price and allowing for there to be contango and backwardization. And futures prices reflect market expectations of supply-demand imbalances. We're assuming the expectations are rational, and that information asymmetry can impact short-term price discovery. So the key insights of this particular model, I'm not going to show you any of the math. The key insights are that price serve as signals for resource allocation and investment. So prices go up, this leads to more investment. Prices go down, this leads to less investment. And speculation and hedging play major roles in price formation. So a quick example of price discovery in natural gas markets. So increase in shale gas production due to advancement in controlling fracturing will lead to an increase in supply and a decrease in the price. Seasonal production constraints also affect price, such as Gulf Coast disruption to supply. For example, the Henry Hub down in Louisiana is the primary port at which we ship out LNG. So if that's down, you can't ship it out. That will lead to a glut out of the market and will push down supply in the United States. Elsewhere, that will lead to an inability to buy LNG and will push prices up. So you have that friction in prices across space, and you have a hurricane making prices more distorted. Then demand factors, you can have growing demand from LNG exports and power generation. Maybe in the winter it's really cold, so you need LNG to power your grid or keep you toasty, keep you warm. It's like a blanket. And you have weather-driven heating and cooling needs. Long-term climate change will impact how much demand there is for heat. Obviously, it will lead to more demand for cooling in the summer, but will also potentially lead to more severe storms, which might lead to an increase in demand for heating because of the increasing extreme weather events. And then market structure, there's financial trading at the Henry Hub, future prices, and arbitrage opportunity between physical delivery points. And the outcome, future price signal expected supply-demand imbalances, and short-term price spikes during cold weather or shocks. So applying Medlock's model to a commodity supercycle, the idea that there are these long cycles in commodity markets that we don't necessarily expect due to traditional supply and demand factors. Demand shocks, rapid industrialization, urbanization. Think about the China shock. China's major growth in the 2000s. Long-term shifts in consumption patterns for commodities like metals, energy, and agricultural products. So there's long-term demand shocks. There are supply constraints. There's a lag in supply response to infrastructure, capital investment, and resource depletion. And there are constraints in production capacity during peak demand. And there are market structure dynamics where it's difficult for supply to directly respond to increase in demand. And so over time, you have an overinvestment and an underinvestment, and this leads to long cycles where future prices anticipate sustained imbalances in a commodity supercycle, which incentivize investment, which leads prices to fall. So you're talking about Medlock's model. You see investments, prices. You see prices rise, causes investments, prices fall, and then essentially prices change based on how quickly supply can adapt and how much of a supply and demand imbalance there is. All right, thank you. This is the end of the Fundamentals of Derivatives lecture. Hope you have a great day.